Real estate has been one of the main drivers of wealth for over 50 years in the United States. But is that going to remain the same for the next 50 years? Well, that's an interesting question. It's one that I am about to dig into. We're going to take a look at the hidden data. Most people look at the prices of homes and think they're expensive, but are they really? What is the real data that people need to be looking at? What's the demand like? What's the prices like? What's happening with interest rates going from 3% to 5%? What's happening with this tax on unrealized wealth? And what are the hottest areas in the United States to buy real estate in and in the world? And what are the areas you should stay away from? These are all good questions that you need to understand if you want to buy real estate, whether personally or as an investor. And these are questions that we should ask a real estate professional like my good friend Jason Hartman, who is going to come back and answer the tough questions. There's a lot of nuance to this, a lot of nuance. You want to listen to this conversation. I also want to let you know that Jason Hartman is going to not just be a speaker, but actually hold a workshop at my event, marketdisruptorslive.com, coming up very soon. He's going to hold a workshop and show the average person how, with a one-time low-dollar cash payment investment, most people could probably retire within 5 or 10 years with a one-time payment, with a very interesting training system that he has. He's going to break it all down at the workshop. You do not want to miss this. Of course, if you'd like to be financially free, I guess. He's going to be doing this at marketdisruptorslive.com. There's a link down below. Come hang out with us. Jason Hartman, George Gammon, myself, Luke Grumman, Daniel DiMartino Booth, Harry Dent, Robert Breedlove, Lawrence Lepard, Greg Foss. I mean, it goes on and on and on. There's a link down below. Hang out with us. Other than that, let's go ahead and just jump right into the interview with Jason Hartman and dig out these questions. All right, Jason Hartman, thank you so much for joining me today. A good friend. You've been on the channel multiple times, but thanks for taking the time to sit down and talk to me today.
Hey, Mark, it's always great to chat with you. I love the brainstorming and the predicting of what is next in the markets. It's always fun.
Yeah, we're like collectively trying to read the tea leaves or something, right? Like I always say, I wish I had a crystal ball. It'd be so much easier. But yeah, we're trying to kind of read the tea leaves, and we're just trying to guess, what comes next. Yeah. They say the markets are a discounting mechanism. So we're always trying to buy something cheaper today than it will be in the future, or if we're going to short it, more expensive. But that's what we're trying to do, trying to guess. And I love talking to you because real estate is such a big piece of wealth in the United States. It's also usually the biggest investment that anybody would make. And It also probably makes up the majority of their wealth, I would say, as well.
Oh, yeah, no question about it. It's a huge part of the economy. It's hugely important. When people buy a house, they spend thousands and thousands of dollars on furniture, appliances, fixing it up, because no matter what you buy, even if it's a move-in ready house, you're always doing things. Everybody wants something a little different. So people just tend to spend. And so the powers that be have a huge incentive to keep the housing market going because there are so many spillover effects into other parts of the economy.
The powers that be have a huge incentive to keep it going.
Yes, they do.
Explain that.
Well, look, I mean, we live, unfortunately, in a world where we have a centrally planned economy, as all of your listeners know, and the politicians, the corporatocracy, the elite class, they don't want an uprising, right? They want people to be somewhat content, and they also want to keep the customers coming to their businesses. So in an economy where 72% of the American economy is basically consumer spending, right? And that's not true around the world, right? That's really high in America. And if that consumer spending stops, then, hey, the Wall Street folks lose money, the big corporations lose money, the economy tanks, the GDP declines, the unemployment rate increases. It's just a spiral of death, and they don't want that.
Which hasn't stopped it from hasn't stopped the real estate market from crashing in the past. Do you think that they need this now more than ever, or have they always needed it and they just can't control the crashes that happen in between?
Yeah, that's definitely a very good question there. They certainly can't control it completely. And last time, as we went into the Great Recession, we saw certain segments of the structure crumble, right? And really, it was first that the mortgage market was completely out of hand. Mark, there was literally nobody putting the brakes on the mortgage underwriting back in 2002 to 2006. And we all saw what happened. But what a lot of people don't really think about enough, I don't think, is that there were really two phases of that whole scenario. The first phase was the mortgage meltdown, and that was pretty easy to predict. I predicted it. I was doing lots of talks about it way back then, and lots of realtors would argue with me. But all you had to do back then is know that there were all these adjustable rate loans in the system, millions of them, and they were all underwritten at ridiculously easy underwriting criteria, and they had teaser rates for the first 3 to 5 years. And you just could tell when, probably everybody has seen at one time or another, maybe in their biology class back in school, but I'm not a biologist. Just have to throw that one in because that's the cultural meme.
Yeah.
Yeah. But, saw like a snake eat a mouse, right? Or something. I remember seeing that the first time as a kid. I was kind of shocked by it, but it's like this big bulge going through the snake. And so the same things with these adjustable rate mortgages, you knew when they were going to adjust, and they did, and people got payment shock. So that was way back then. This time, we don't have that. We have different issues this time around, and the economy is much more, I would say, controlled and regulated than it was back then. And I'm a big fan of not having it very regulated, but that's a whole rabbit hole we could go down.
Yeah.
Yeah.
So one of the big misconceptions is that in leading up to 2008, it was the homeowner who had become too greedy and bought too many homes because credit was extended to them too easy. And because they were so greedy, they bought so many homes they couldn't afford, it crashed the whole system. The reality was, and this has been disproven many times, I'm sure most people are aware of this, but the reality is it wasn't the homeowner buying the homes that caused the problem. It was the banks that were bundling these things together, and these investment banks having no way to even manage their risk, knowing what was even inside of these, the sausage, if you will. That really is what crashed the entire system. And so I guess what you're saying is we're not seeing that same thing, that same problem today.
No, not at all. Not in the mortgage world, at least. I mean, you could argue that auto loans or various other types of debt, student loans, they may have other types of issues. But what you just alluded to, Mark, was phase 2 of the problem. See, the simplistic mortgage meltdown, yeah, that was a problem. But what was really the bigger problem was what you just mentioned: the bundling of the loans, the acronyms that we all learned after that, CDOs, et cetera, where there were these sort of fake insurance products that all of the investment banks and the Wall Street tycoons were using. And really, it bankrupted the country of Iceland. I mean, it was so far reaching in its global impact. It was absolutely incredible what happened last time around.
Now, going back to the politicians, they want real estate to be higher. I can think of many reasons why that would be the case. So, for example, you made the point about GDP. So we have a debt to GDP, nationwide, that's dangerously high. It had gotten above 130%, which is like the point of no return. It came back slowly, but to your point, if real estate were to crash, it would suck the money, the numbers out of the GDP, which would then really exaggerate that. Another reason why, to your point, I mean, people feel rich when they have that. That's good. But even more than the wealth effect, yeah. But then we also have all the collateral that's been pledged for these loans. So the whole system is based off of debt. And what happens is if asset prices start going down, then collateral starts not being good enough.
Right.
And then debts become called, and then it causes this liquidity crisis, which is a downward spiral. And then finally, I don't have the exact numbers in front of me, but I've looked at the data that shows that the amount of revenue the government brings in from capital gains is making a huge chunk of their budget these days. And if asset prices stop going up, then capital gains stop coming in, and a huge chunk of their revenue. So we just saw this week Biden talking about this new tax plan, and he thinks it can raise an extra $2.5 trillion in taxes by, I think, repealing some of these Trump tax cuts. And so they need that revenue. And if cap gains go down, then they lose a big chunk. So those are all good reasons. I mean, those the kind of the same you're looking at.
And there's definitely more than that. There are other taxes, not the least of which are the local taxes. So, all these municipalities that depend on property tax revenue, if values go down, that hurts them in a huge, huge way. And as you alluded to, it's a domino effect because the whole world economy, I mean, every economy, it's all the same game. It's all just one big giant bubble that has got to keep inflating because so many things depend on it. And it's hard to know in a world like this what anything is truly worth, right? Because we have all these and when I say this, I don't mean it in a technical way to define the actual instrument, and the word is derivative. But there are so many things that aren't really derivatives per se, but they are still derivatives, right? Because everything's just attached to another thing. And so it's a very interconnected world.
Yeah. Now, if they don't want real estate, I mean, obviously the homeowner doesn't want prices to crash. We can make the case that the government, the powers that be, municipalities, et cetera, don't want the markets to crash. Wall Street doesn't want the markets to crash. But what are the factors that keep the market going? Yeah. So, for example, I mean, everything goes down to supply and demand, right? So as long as there's more people buying than there is inventory available, prices would go up. And so it seems that it would be, is there access to loans?
Right.
And can they afford them?
Yep. Very significant. Real estate, like many other things in our world, is a credit-based asset class. And when credit dries up, a lot of us, you and I, we're always looking at the money supply, right? But it's not just about the money supply, it's also about the credit supply, because credit is money, right? And so when credit dries up, it certainly can affect the real estate market, no question. And we've seen a pretty significant increase in mortgage rates just recently. Now, that has really had the opposite effect of what many might think. It has not cooled the market. It's actually heated the market up to beyond its former red hot status because people have FOMO, the fear of missing out. And they're just trying to buy any property they can right now because they think this may be the last of those low rates, maybe in their lifetime. And that's actually quite possible. But another thing that's interesting to note is that about 40% of all the mortgages in the country, or all the homes in the country, I should say, are free and clear. And many of the purchases are cash purchases. So to those purchases, it's not a credit-based asset. Now, another metric that's interesting to look at is about 33% of the entire market for not new home, but just real estate purchases is investors. And many of those investors are cash buyers like the institutional buyers. Now, granted, they're also financed with debt, but it's a completely different concept of debt that's, through the banking system, the investment banking system, really, and through Wall Street. So these are all just factors that, some of them didn't exist the last time around. And I hate to say what is considered by many to be the famous last words of any investor. This time it's different.
Right.
But it really is different.
Sure.
I mean, there are many differences.
That's why we say history doesn't repeat, but it rhymes, right?
Yes,
so it's a little bit different. So going back to that, so you talked about, let's talk about the supply and demand metrics, because ultimately that's what we're always trying to figure out. Will the demand continue to stay strong, and what's going to happen with the supply? Yeah. Ultimately, that's what's going to drive it. You talked about mortgage rates. So mortgage rates, 1981 were over 18%.
Yep.
And they've basically come down ever since. It's not in a straight line, but almost in a straight line. Right. They appear to have bottomed just recently, just over the last year, in the mid twos, and now they've jumped as high as almost 5% in just the last 2 months. Now, if I look back at that historically, we're kind of in this range that we've been in since about 2011. So really like the last decade, it seems like now it's come up and down, but maybe if I were to look at some technical analysis, there's kind of a line there, like a median. Do you see that jump from, let's call it 3% to 5% really having a massive impact?
Well, that is the trillion-dollar question for sure. So many factors in answering that question. Number one factor that very few people really understand. I don't know. Humans have a funny mentality about this, and I've really tried to teach around it on my podcast and on YouTube. And that is the idea that there is some like fixed idea of, look, okay, you can say, well, if mortgage rates go up and that causes the payment to go up by X percentage, then people won't be able to afford a house. That's what you keep hearing, right? That's the kind of narrative you hear. But that's simply not true. And here's
Really?
why it's not
Yeah.
true.
Tell us
because
why.
what gives is this. What gives is what people are going to get. They're still going to live somewhere, right? They're just going to have to accept less. And you teach your listeners, I know, about hedonic adjustments, just as I do, and hedonic indexing, which is one of the ways they manipulate the consumer price index, the measure of inflation.
Right.
And they say, well, hey, this iPhone is twice as good as the phone I got 10 years ago. And this phone costs $1,500, but the consumer price index by hedonic adjustment, since it's twice as good as the old one,
Right.
considers that I only paid half as much for it. But that's not really true. I didn't really only pay half as much. So it's a hedonic adjustment.
Yeah,
and
ridiculous.
it is. But we as people have hedonic adjustments. We have expectations. So one of the examples I might share at your upcoming conference, which, by the way, Mark, I got to tell you, I'm so excited for Market Disruptors Live. It's going to be awesome. I was at the last one in Miami, and folks, if you don't have tickets for Mark's event yet,
get them.
You're really crazy. You got to get tickets because, it was just a lineup of all-star speakers and networking and education and fun too. It was also very fun.
Yeah.
But
thanks for that.
I might share this in pictures at your event. And I give an example of a $1 million home in Jacksonville, Florida. And then I give an example of a $1 million apartment in New York City.
Yeah.
And the home in Jacksonville is almost 5,000 square feet. It's on a big corner lot. It's got a beautiful yard, gorgeous. It's just a gorgeous home. A big palatial master suite with a big master bath and, everything, you'd want in a great house. It's a little mini mansion, basically, right? And then for the same amount of money in New York City, you get 653 square feet, Mark. And, it's called a 1-bedroom, 1-bath, but it's not really even 1 bedroom. It's just
Jason, I live in Southern California on the beach, man. You don't got to tell me.
you understand, right?
You get a bungalow.
Exactly. But that's a hedonic adjustment.
Yeah.
Okay. People, what gives is the standard of living. People just get less. They'll just accept less. They have no other choice. Right? So they could have afforded a nicer, bigger, better house when prices were lower and interest rates were lower, but now they're going to just take a smaller house in an inferior neighborhood. They're still going to buy a house, or they're still going to rent a house. They're just going to get less. The standard of living is declining. That's the reality.
Yeah. Well, but the last piece you just said there, they're still going to buy, or they're still going to rent. So
Right.
I want to talk about that, but so if I look at this though, I believe the data, correct me if I'm wrong, but approximately like 96% of all homes purchased are financed. I don't know, maybe you said there's a lot of cash. Maybe that number has come down.
Yeah.
I think I saw that number reported from the Realtor Association about a year ago. But a good majority, almost all of the homes being purchased are being financed.
Yeah.
And so people are buying the monthly payment. They're not buying the price of the home. So when people say homes are the most expensive they've ever been, well, in purchase price, total dollar amount purchase price, maybe that's the case. But in monthly payments, maybe that's not. And so
Right.
I think the way the process works, I mean, obviously I bought over 100 homes, and most of those were cash, but the way that most people would do it is I would go sit with a mortgage broker and they'd say, how much do you make? And I'd say, whatever, 100 grand a year. And they say, okay, based off loan guidelines, you can spend 40% of your income on your home. So that's 40,000 a year. Okay. 40,000 a year gets you this payment, and this payment can get you this much of a house.
Right.
So they kind of walk you into it that way. So, if my income doesn't change, I'm still making the 100,000, but interest rates went up, then I am going to be able to buy less of a house.
Yep.
So then you would think that prices would have to come down, but I guess what you're saying is that's not necessarily true, because home prices don't necessarily have to come down. That person might just buy a cheaper house.
A few things on that. Let's unpack it a bit.
Yeah.
So the first thing to know is that, like that stat you just mentioned about all the homes being financed, the cheaper the mortgages, the more people will use them, the more are financed. When the mortgages get more expensive, just like anything else, fewer people buy them. Okay. So more purchases will tend toward cash or larger down payments if people have the money, and there's certainly a lot of money in the system right now. Granted, it's fiat money.
Yeah. We'll talk about that later, but yeah.
Yeah, that's a rabbit hole we don't have time to go down. So as the mortgages get more expensive, fewer people will use mortgages, right? So the actual equity, there's an incentive to increase your equity, right? That's one thing. Another rule of thumb to remember is that 1% in mortgage rate is equivalent to about 10% in purchase price. Okay. So, for the uninformed person who doesn't really understand the dynamics completely, they think, well, if mortgage rates go up, then all the prices are just going to drop 10%. No, that's not true. That's what happens to the standard of living. That's what drops.
So the price doesn't come down. They just buy 10% less home.
Exactly. Right. And so what happens is there are all of these other factors going on at the same time. So the first one is the FOMO factor that we discussed earlier. So when rates go up initially and there's that initial shock, everybody actually rushes into the market. Many think they rush out
get it
of
before
the
it's gone. Yeah.
Yeah. Get it before it's gone. Hey, we're raising the prices, a little bit each day. So you're going to go out and shop, right? Just like in the Weimar Republic, when your money's getting worth less and less, you spend it, right? You don't save it because it's going to be devalued. You want to spend it, right? That's the incentive. And so that all happens. But the other thing we got to just talk about is inventory. Okay, it would be completely remiss if we didn't discuss inventory.
Well, before let's not jump into inventory yet. I want to get into the supply demand pieces. We'll talk about that, but just kind of sticking on this particular part with the mortgage rates, the price of the home. We talked about the affordability, the payments. The other thing that I wanted to come back to, you mentioned before I started talking, was the rent. People are either going to buy or they're going to rent.
Right.
And you were making the case that you got to live somewhere.
Yeah.
You're just going to live somewhere less.
Instead
of a 3,000 square foot house, now it's a 2,000 square foot house or whatever it is.
Exactly.
Instead of living on the beach, you now live 20 miles from the beach.
Instead of living in the best school district, you're going to live in a inferior school district, whatever.
But let's talk about that. So there's also a ratio of, or typically when it's cheaper to buy, people buy, and when it's cheaper to rent, then people rent.
Right.
And so rents have gone up like crazy. As a matter of fact, a handful of states went up over 60%.
I know. It's absolutely shocking.
I think it was,
and they're still going up.
I think it was Gilbert, Arizona, went up 108%. It was like the highest in the nation. But several states, I think 2 or 3 at least, went up over 60%. Many went up 40, 50%. So rents have gone up crazy. And so is the rent versus buy decision one of those key pieces? And if so, what's happening with that ratio in light of where prices, mortgage rates, and rents are at right now?
Yeah. Well, remember, prices always precede rents in their increase, and rents always lag prices. So what you have is, as cheap debt is available or low housing supply occurs, the prices always rise really quickly. Because think about it. Everybody knows, if they look around their own neighborhood, that every time a sale happens in a market that is increasing, in a hot market, it sets a new comp. And that comparison sale, each one feeds off the other. And you could have 3 comps set every month, or at least 1 comp maybe set every month as one house sells. But when it comes to rents, typically they're on 1-year leases. And so they only raise the rents once a year. Now, here's another factor that a lot of people don't realize, and I predicted this a long time ago. Haven't heard anybody else talk about it except yours truly, and that is the impact of these institutional investors, whether it be Invitation Homes or American Homes for Rent, these companies that own tens of thousands of homes. Now, understand this, that the overall housing market is still dominated by mom and pop investors that own about 18 million rental units. All right. But these institutional investors are starting to become a bigger and bigger part of the marketplace. And one of the things that's interesting about them is that they are much better at raising their rents and really making that portfolio of properties just squeeze the juice out of it. And people know this because those institutional investors have for decades owned big apartment complexes. And anybody who's lived in a big apartment complex will tell you, man, they're just relentless about these rent increases. Same with self-storage units, they're just relentless. They just raise the rent every chance they get, and they raise it a lot.
Right.
And so those rents are also a comp. And the institutional investors playing in the market are actually going to be a benefit to individual mom and pop landlords, because they're going to set higher rental comps, because individual mom and pop landlords, I got to just tell you, they're not very good at raising their rents. A lot of them are lazy. They, they sort of think like, I don't want the tenant to move. I'm too scared they're going to move. They're a good tenant. They pay. I'll just leave it alone, or I'll just raise it $20 when they could raise it $250, okay, or $400. And so we're going to see much higher rents. Rents are still lagging. They're still catching up to these price increases, Mark. And rent increases are going to be happening for quite a while. And so then, very significantly.
So then do you predict that you think that it will continue to be cheaper to buy for quite a while because rents will continue outpacing the rate of a home purchase?
I don't know. That one really depends on the market. It depends on the city, depends on the product type within that market. It's a pretty complex question.
Sure. So to kind of, I said like Gilbert, Arizona went up by 108%. It might not have been Gilbert or somewhere in Arizona. But then like I saw places like in Ohio or Indiana that actually went down.
Yeah.
And so one of the things that we'll dig into, I want to get to later, I'm going to ask you, what are some of the best real estate markets in the US? And then what are some of the best globally? So everyone's paying attention, make sure to stay tuned for that. But the one key piece that I want the listeners to tune in on is we'll get to that. But something that you and I, and maybe you taught me, or we've talked about extensively, is that there is no such thing as the real estate market. There's thousands of submarkets broken down by price, location, type, et cetera. And so just to that rent demand area, one went up over 100%. Some places actually went down.
Yep.
So anyway, back to the question I asked you, you're saying that it's probably hard to forecast or predict if you think if it will continue to be cheaper to buy than rent. And it has been, though, it has been cheaper to buy than rent. And so if it starts to be cheaper to rent, then we might see more people renting and not as many home sales, potentially. That's something to watch.
Yeah, it's something to watch for sure. And the reason that's a tough one is because, the buy equation depends on obviously the price of the home and the interest rates, and the rent equation just depends on the rent for that specific house, right? And that comparison, and people are always weighing their options. So if the Fed really sticks it to us and they keep raising the rates as they say they're going to, I mean, they've been pretty bold and public about their proclamations there. We may see a point where the rents are cheaper. We just don't know. We'll have to see how it all turns out. But I've taught a strategy for the last 18 years. I call it the 3 dimensions of real estate. And we've never talked about this, but I remember I had this epiphany back in maybe 2002 or 2001. I was at the car wash, and this was in Irvine, California, when I lived in Southern California. And I was at the car wash, and I ran into my friend Nancy at the car wash too. She was getting her car washed, and she works for IAC, or at the time worked for IAC, Irvine Apartment Communities, one of the largest apartment owners in the country, huge apartment owner. And I said, "Hey, Nancy, how's business at IAC?" And she said, "Oh, Jason, it's terrible. We're having higher vacancies, and it's just not that good." And I said, "Why?" And she says, knowing that I was in the real estate business, she said, "Because they're all buying houses from you, because rates were so low at the time. Now, of course, they got lower, but at the relative to the market, rates were really low then, and the underwriting criteria was really sloppy as well. So credit availability." And by the way, one more thing on that, Mark. You did a show once, I remember watching a YouTube video where you were talking about the Mortgage Credit Availability Index, published by the MBA, the Mortgage Bankers Association. And I use that too, because people have to remember, it's not just about the mortgage rates, it's about the availability of mortgages. It's a twofold discussion. Not just are rates low, but can you take advantage of them?
Right.
Right.
Is there liquidity? Yeah. Okay. So let's go into then the supply and demand equation. So a couple things there. So one, you had mentioned earlier institutional investors. So we saw a massive entrance of institutional investors. BlackRock's buying all the homes, Zillow's buying homes, et cetera. And that they were paying, I saw reports over 35% over market value for these homes. Of course, they can't, because they're getting basically free money. And so their numbers are completely different. However, and so that's been a big piece of supply and demand. And so then regular people have to bid a lot more to get that home. However, a couple things. One, Zillow had a horrible experience doing it. I think they exited the market.
Well, and then, Mark, are you saying to your listeners here that you can't make a business out of losing $28,000 per home?
Well, only if you're Uber. But then we also have like the big institutional investors like BlackRock, where, hey, they're cool making 3 or 4% because when they got hundreds of billions of dollars, what are you going to do? But
they can wait. They're patient.
But when the Fed raises the rates and they can make 3 or 4% just at the Fed, maybe they go back to that and get out of the home market. So do you have any thoughts on that, as far as, is that going to be a big swing one way or another in the near future?
Well, the other part of it we have to look at is another strategy I teach called packaged commodities investing. And we've got to remember, whether we're BlackRock, Invitation Homes, American Homes for Rent, or Mark Moss and Jason Hartman, right? Or anybody listening, we are not really real estate investors. We are commodities investors. Okay. Because we're really buying. I mean, in the markets we recommend, and I know we're going to talk about different markets in a moment, Mark. Yeah. But we buy markets where the land value is actually very cheap. The land is a low percentage of the overall equation of that purchase price. So it's mostly the improvement sitting on the land, the house or the apartment. And what is that made of? Well, it's made of lumber, it's made of concrete, copper wire in the walls, glass, steel, petroleum products, energy, and human labor, right? And other things, of course. So all of these ingredients, or these commodities that are the construction materials for a house, are really, really important. And I believe we're going to be in a commodities bull market as a long trend, a super cycle. Now, granted, there will be ups and downs along the way, of course, like in anything. But the overall trend for commodities demand, especially for construction materials, which every human being on Earth needs, is going to be huge. I mean, we're still in a world, keep in mind, we're still in a world where, yes, we've seen a lot of people lifted out of poverty by globalization, over 300 million people, with the development mostly of China and India. But there's still a long way to go. Sure. There's still what we call not the rising billion, but the rising 3 billion. Right. There's still 3 billion people on Earth that are going to be consuming more and more. And all of that more and more includes construction materials. And those construction materials are what we're investing in. But we're getting 30-year mortgages at low fixed rates, even though they're higher than they were, a year ago or even a few months ago. They're still cheap historically.
Yeah, it's a good way to look at it. So if you're buying the commodity, you're buying the steel, you're buying the concrete, you're buying the lumber, do you think those assets, those commodities will be higher in the future or lower? And I would agree with you, right? We're seeing the entire market rotate from growth into value into commodities. We are in this commodities boom, commodities super cycle, maybe even. And so you're buying commodities cheap at a 30-year rate, historically low rate. It's one interesting way to look at it. I want to get into some actionable stuff for everybody listening, more specific stuff. But before I do that, do you have any data on the real estate market as of right now? Meaning, is the demand still high? It seems like sales are slowing, but yet still growing. Meaning they're still growing, but the rate of growth is slowing. New listings coming onto the market. Now, the one thing that I have to continue to stress to everybody is this is anecdotal when we talk about it collectively through the country, as opposed to granularly in certain areas, which we're going to talk about those granular circular areas. But I guess if we did look at it from a bigger macro picture, maybe it helps us kind of see what the Fed funds rates doing, the mortgage rates are doing. But do you have any kind of data on that to show us the demand there?
Yeah. So I'll just share my screen for a moment. And then, of course, for people just listening on audio, we'll tell them what we're seeing here. So I thought I'd start off with a house that's half underwater.
Okay.
Just to please all the naysayers out there.
Yeah.
I don't think that's the case. Or I don't even think we're near that. But, the question of will we see a bust? Will the bubble pop? Of course it will. At some point, nothing goes on forever. There's always a correction. That's the way markets work, okay?
Sure.
The question is when and how much. So Altos Research publishes a weekly market index. And what they do is they have this little speedometer of, is it a seller's market or a buyer's market? A seller's market being a really hot market where sellers are making the rules and they can command the deal, and a buyer's market being more where the buyers make the rules. We haven't seen that in quite a while. But what's interesting, and I teach about the three basic types of markets around the country: linear markets, cyclical markets, and hybrid markets.
Right.
And I grew up in Los Angeles, California. You live just south of LA, in Orange County. And LA is a cyclical market. It's a market that has really big highs and really ugly lows, and it goes up and down like a roller coaster. And one of the things I have been waiting for, and I think it's finally happening, but we're just at the beginning of it. It's a nuance, right? There's not enough time has passed yet. But the LA market is cooling just a bit, okay? It's still considered a seller's market, but it's right on the cusp of where it's cooling into an almost normal market that has, gone up a lot, and it's been really, really crazy. But we always have to answer the question, or ask the question, compared to what?
Right.
So another market across the country that's been a really hot market, that's a formerly linear market that's turned hybrid, meaning that the prices just sort of chugged along and did their thing. But at some point, Mark, it kind of caught fire and everybody got interested in this market. And, these are places like Denver, Austin, and the next one I'm going to show you, Sarasota, Florida. Okay, this has been a really, really hot market. And in the past week, it actually got even hotter on the scale of 100 being an absolute seller's market where there's like no inventory, where the prices are just, everything's multiple offers, selling above full price. Sarasota gets an 84 out of 100. LA gets a 59. So
it's a perfect example of no such thing as the real estate market. It's very granular. And so a big gaping difference from LA to Sarasota, Florida.
You got that right. And so there's, the Census Bureau uses the MSAs, the Metropolitan Statistical Area. There's almost 400 of those in the US. There's over 3,100 counties in the US. and there's over 9,000 cities in the US. All real estate is local. These markets are very different.
One thing I like about this too, and you kind of alluded to this earlier, talking about the $1 million mansion in Florida versus the $1 million condo in New York,
Right.
is that homes are expensive compared to what you said that. So I know, Florida got hit super hard like Southern California did in the 2008 crash. And I remember by, a couple of years ago, everyone's like, oh, Florida real estate, it's so expensive now. It's so expensive. And they were saying it was expensive compared to where it was at the 2012 lows. But not expensive compared to if you were moving from New York or California.
Yep.
And so Florida real estate was expensive compared to the low, but compared to if you're coming from upper Midwest somewhere, California, New York, et cetera, it's actually really cheap.
Yeah.
And so that's something to always keep in mind is compared to what. And if you're coming from, some of these more expensive areas and you're moving into a cheaper area, even though the cheaper area has gotten more expensive, it's still very cheap.
Yeah.
And so you have to look at that.
That's a geo arbitrage.
Arbitrage,
Absolutely. So here's a chart that'll blow your mind. Okay. And this just speaks to the absolute shortage of homes over the last decade. So you see the kind of construction that we had in the 30s, even through the Great Depression, right? The 40s, the 50s, the 60s, right? The number of homes built by decade. And you look at the last decade, 2010 to 2020, hardly any homes were built, comparatively speaking. But it gets even worse than that in terms of the amount of inventory. Because if you segment that by the market and you look at entry-level homes, there has been almost nothing built. I mean, where are all the $100,000, $200,000, even $300,000 homes? They just are non-existent in this country nowadays.
Do you have any reason, any guess as to why? I mean, is that because from 2010 to 2019, we're kind of recovering from the 2008 crash, or why?
Yeah.
I mean, they didn't just drop; they went off a cliff. I mean, they dropped by 75% or more.
Yeah.
Do you have any reason why that happened?
So we overbuilt leading up to the Great Recession, and then that inventory had to be absorbed. And the home builders really just went into hibernation mode for a while. And then they slowly came online. Remember, the fuel for home builders is credit availability.
Sure,
they've got to have money to finance their projects. And the way they think is, look, it's not my money. Okay. Right. It's not like the president of D.R. Horton's got his own money in all the deals and the homes he's building. Okay. It's the marketplace, right? It's whether the Wall Street machine can feed them the money. Right. And so that money started to slowly ramp up as we got into maybe 2013 and 14. And, most of that inventory from the Great Recession was absorbed by then. And then it just takes a long time to get that machine going again. It's like a 4-year cycle, really, in terms of that business plan to get the machine going. But also, the home builders realized that as regulation increased, and as the cost of materials increased, and as the environmental regulations increased and that burden got bigger and bigger and bigger. A lot of people don't realize this, that when a home builder, they want to develop a subdivision, they've got to pay a massive amount of money to put in the roads and the sewers and bring the electrical up to the curb. And I mean, there's just a massive amount of money that goes into all of that stuff. And if it's in some places like the Socialist Republic of California, just multiply it, by at least threefold probably. And so they realized that there was just no money in building entry-level homes anymore. They just couldn't make it pencil. So what they did is they started building all mid and upper level homes. And guess what? All the first-time buyers were coming of age, the millennial generation, and now Gen Z after them. And so you've got this huge disconnect between supply and demand.
Right.
And one of my millennial team members who does some video editing work for me, he said to me one day, he said, I don't get it. I listen to your stuff and you keep talking about how there's all this demand and no supply. Why don't the home builders build it? And I just told him, I said, don't you get it? Because it's not profitable for them.
Right.
They're not going to build something that they can't make money on.
Yeah.
So-
Well, it's too. The costs are too expensive. The land's too expensive. The materials are too expensive. The government regulations are too expensive, and all that.
Right.
Man, there's so much more I could dig on into that, but man, we're kind of getting out of time here.
Yeah.
So let's try to get to a little bit more practical stuff. Remember, there's no such thing as the real estate market. There's thousands of submarkets, and it's really being exaggerated because of what I've been calling the Great Migration, which is the baby boomer generation selling their McMansions in the Midwest where it's cold, moving to the Sun Belt states where it's cheap and warm. But now it's also being really exaggerated because of the pandemic situation and people being able to work remotely, and companies and people thought they never could do that. Now they're finding they can. And so what we're seeing is real estate in Idaho and Montana and Colorado is blowing up. People always wanted to live there, but they couldn't work there, live and work there before.
Right.
Also, like I have a buddy who bought, I recently bought a place in Texas outside of Austin. And I have a buddy who bought a house there on Lake Travis in Austin, bought it for $10 million a year ago, sold it for $25 million.
Wow.
So that means that home went up by 150% in a year.
Unbelievable.
Well, there's only so many homes on the lake. And now you have all these Silicon Valley companies moving there, including Meta just moved there. And if you make $100 million a year and you want to live on the lake,
so
what do you care if it's 10 or 20 million, right?
15 million is nothing. Yeah.
Right. And so that's supply and demand really playing out. So based off the great migration of the baby boomers and now the internet boom or the Zoom pandemic,
the Zoom boom. Yeah.
The Zoom boom thing. Where do you think are some of the best real estate markets in the US? And then maybe even globally, if you look out that far?
Yeah. So great question. And I know all about your ranch. You showed me all the pictures and I'm super excited for you. I think what you did is really smart. And, we really can live in these quality of life areas now because we're much more detached from location.
Right.
One of the things I've been saying for about 10 years now, Mark, is geography is less meaningful than it's ever been in human history. Geography is less meaningful than it's ever been. Or
it's more important.
Well, yeah. Here's what I mean when I say that. It used to be that you had to live near work. You had to live near the city, right? And now you can live anywhere as long as you've got a good internet connection. Right. And that's why it's less meaningful. I mean, look.
It's less meaningful. I have to be in the city, but it's more meaningful where now I want to live where there's natural resources. I want to live where there's fun, where there's beauty,
quality of life.
Exactly.
Yeah. The quality of life areas. I remember, you might remember this author. His name is John Nesbitt. He wrote a book series called Megatrends. Okay. And I remember I followed his work extensively when I was in my 20s and 30s. And John Nesbitt, I used to subscribe to his newsletter. And one of the things he said in his newsletter, Mark, you'll love this, is he said he moved out of the city and he moved his company, his futurist forecasting company that, is behind the Megatrends book series, which was huge. He moved it to Telluride, Colorado. And this was in the 90s. And the big technology at the time that allowed him to not have his company in Los Angeles or San Francisco or New York was, you ready for this one? The big technology that allowed this. No, it wasn't even the fax machine. It was Federal Express.
Oh, wow.
It was FedEx. Okay. Yeah. And he said he could live in a quality of life area because of FedEx. That allowed him to do business really effectively living in Telluride, Colorado, this beautiful ski town, right?
Yeah.
So, yeah, it's interesting.
So then what do you think some of the best real estate markets are in the U.S.?
Yeah, I think suburban locations. People want to live in suburbia. Suburbia has become cool again. America is really known for suburbia because after World War II, we had Levittown. We're one of the few countries really on earth that is big on suburban living. Okay,
that's so people fleeing the big cities.
Yeah, that's not true around the world like it is in America. It exists, but not like it does here.
Right.
And so these good linear suburban markets Of course, we have many markets in Florida that we're helping investors buy properties in. And by the way, that's what my company does. We help investors build nationwide real estate portfolios.
Right.
So, of course, many Florida markets are fantastic. Texas, good, not as good as it used to be. It's gotten a little expensive. Of course, the property taxes are pretty high in Texas. Tennessee, there are some great markets in Tennessee. Georgia, there's a little bit. Indiana, there's still some good stuff. So these types of markets, and shameless self-promotion here, go to jasonhartman.com for more on any of this stuff.
Yeah, and we'll make sure we'll put that down there. Now, what about strategy? So, early on in my real estate career, I got smacked really hard in the 2008 crash, and I learned that there's no such thing as good and bad timing. Yep. It's just good and bad strategies. So when the timing changes, you just change your strategy. Yep. So when I was building homes, and then in 2008, when liquidity dried up, that wasn't such the good best place to be, but buying distressed assets was, right? So what do you think the right strategies are for these markets? Yep. Like cash flow, rentals, Airbnb rentals, like what are you seeing there?
Great question. And that is the $1 trillion question, of course. But, my answer to it would be, we talked earlier about my 3 dimensions of real estate, and I didn't quite finish the idea. Okay. So, the beautiful thing about income property is you can adjust your strategy based on what's going on outside in the marketplace, right? And in the economy. So when we're in the market we've been in over the past several years, which is a capital gains market, you make big gains and you do what I call refi till you die. That's another strategy I teach. You pull that equity out, you make it work for you. Maybe you buy Bitcoin, maybe you buy more properties, whatever. You want to have your equity working in those capital gains markets, or maybe you just take gains and take it off the table and sell. Right. But in a market where prices soften, that tends to actually push rents up. Because remember, people only have 3 choices. They can buy, they can rent, or they can be homeless. And nobody wants to be homeless. So if it's more of a rental market, you sit back and you collect your cash flow. I think it's still a good time to maximize the mortgage opportunity. I know people might think, Jason, the rates are so high, I should just pay cash. No, you shouldn't, because the official rate of inflation is still dramatically higher than the 30-year fixed rate mortgage. So stock up on those cheap 30-year fixed rate mortgages and take advantage of inflation-induced debt destruction. It's a beautiful, beautiful thing. So the strategy is buy more properties. I'm still a buyer. I've been buying properties. I got 2 that I'm doing right now personally for my own portfolio.
I closed on a couple this year as well.
Yep, good. And just, be smart. You always have to be smart, stay informed, listen to Mark's show, follow his YouTube videos, because things do change, of course, and get those 30-year fixed rate mortgages. And, I think we're going to see quite a bit more in terms of price appreciation. But if we don't, then sit back and watch the rents increase as there's upward pressure on rents, because the people are forced to stay in the renter pool because buying is not attractive to them. Yeah. So that just puts upward pressure on rents. Either way, you win as long as you adjust your strategy.
Now, most of this, I guess this is there's all types of home buyers. Obviously, we could separate the homeowners versus the investors. Right. For example, I bought a new house for myself and my family. It was not a financial decision. It was a purely emotional decision for my family. If that price of that home goes down by 50%, I don't care, because I didn't buy it based off of financial factors. Now, of course, I look at those, but my home, I didn't approach that way. But let's say that 4 homeowners listening to this, they might try to time this market, which I always think is a fool's errand, but they might say, hey, they got to come down. And I expect prices to drop by 20 or 30%. So I'm going to wait 2 more years and buy it at a 20% discount than it is today. Prices are too high. What would you say to that type of a buyer?
It's a great point. I've been hearing people say that for my entire career. Okay. And I was hearing a lot of people say that in 2015, and look at what they would have missed. Right. Look, historically speaking, every 10 years, there's a big giant real estate boom. And if you are not in the game, you're likely to miss it. Think about it. Everybody in 2019, 2018, they were all thinking there was a bubble. When Trump was elected in 2016, everybody was thinking, oh, there's a bubble. The market's going to crash. I'm going to wait. I'm going to time it. And you missed it. You missed it all. Okay? Be in the market, first of all. But the other thing you have to ask is, if there is a bubble, and there will definitely be a correction at some point. There's always a correction, folks. I'm not saying there won't be by any means. There's always going to be a correction. But why is there going to be a correction? Well, the likelihood of why is because mortgage money will get a lot more expensive. And I mean a lot more expensive than it is now.
Right.
So you're either going to get the money cheap or you're going to get the property cheap. You know, it's like the old saying, you're either going to get price or you're going to get terms, but you're not going to get both at the same time.
Right.
So do you want the cheap mortgage or do you want the cheap property? You're going to pay a lot more for the mortgage, or you're going to pay more for the property, one or the other.
So theoretically, let's say that you were going to buy a $500,000 house and your payment was going to be whatever, $2,000 a month. Let's say that the price of the home drops to $350, but mortgage rates went up and you're still paying $2,000 a month.
Yeah.
Kind of a thing, right? And so you're going to pay $2,000 a month for 30 years doesn't really matter what the price of the home is, because you're going to pay $2,000 for 30 years. Now, if you're a cash buyer, which makes up, less than, 5% of the market, if you're a cash buyer, then maybe you could time it. But if you're buying off of a loan, then your payment's probably going to be the same either way, regardless of the price of the house. The other thing I would say is that when prices do drop, again, why would they drop? Rates went up, liquidity has dried up. Yep. And so one, you may not be able to get the loan at that time at that cheap price, because talk terms might be a lot harder to get. So
or get the loan at all.
Yeah. Now, we'll reiterate, you kindly talked about my Market Disruptors live event.
Yes.
At that event, you're actually holding a workshop. So a lot of people just get their 40 minutes on stage. You're going to get an hour and a half to actually teach people how to find these areas. And you talked about several different strategies that you teach, and talk about strategies, what types of properties to buy, in which markets, ways that you can leverage, grow super fast. It's going to be super exciting. So if you need any more reasons to come to marketdisruptorslive.com, there's a link down below to check that out. Jason will be there talking. Luke Grumman, our good mutual friend George Gammon, of course, will be there. Daniel DiMartino Booth from the Fed, Harry Dent, the father of cycles.
Oh, you got Harry Dent. I didn't know that. That's great.
Yeah. Which is it's a mixed bag on him, but
I know.
I believe his data
with Harry,
is right.
The world is always ending.
I believe his data is right. I think,
it is good.
I think people that haven't taken the time to understand the nuance in his data misinterpret it. So anyway, so marketdisruptorslive.com, come check it out. Jason, come learn some strategies that you can use today. Again, no such thing as good and bad timing, just good and bad strategies. One more thing I'd like to ask you about. Obviously, I'm a Bitcoin guy. I know you are as well, a little bit. So think about the money a little bit, right? And so, about 300 years ago, we really got, and since the beginning of time, really, but about 300 years ago, we really got into this division of labor where I'll make the clothes, you grow the food, and we'll exchange, right? And we use money as a medium of exchange. And over time, that money became a store of value. And so up until the 70s, most people didn't really invest. They just saved in dollars. They worked really hard and they saved in dollars, and that was good enough. But once we came off the gold standard, you could no longer save in dollars anymore. And so it made everybody be the best worker they could be. Also, they had to be an investor. They didn't want to be, I just want to be the best brain surgeon, or I just want to cure cancer, but now I have to be half investor as well. It's a horrible thing. We can talk about that. But my point that I want to go into is that we forced people to become investors. And so now they have to put money in the stock market. They have to put money in the real estate market. They have to put money in all these things. And so what happens is they got, instead of having a utility value, so silver mainly still has a utility value. 80% of it's still used in production, but gold carries a monetary value. And stocks used to trade at 3 or 4 times multiples. Now they're 50 times multiples.
Yeah, it's ridiculous.
I also think that real estate has a massive monetary premium because investors are piling their money in there. But in a sound money system, theoretically into the future, I don't know if that's 20 years or 40 years or 5 years. But theoretically, in a sound money system where I could be the best brain surgeon or cure cancer, and I could just save my wealth in my store value, my money, I wouldn't be forced to invest into stocks. I wouldn't be forced to invest into real estate. And we could see the value of stocks really come back down to where they should be, 4 to 6 times earnings.
Yeah.
And we could see real estate come back down to its utility value. And I almost think,
and don't forget college tuition and healthcare.
Yeah.
Those are complete ripoffs.
But I'm talking about investments that carry this huge monetary premium. And again, I'm talking about theoretically in a world where we had this, which we don't. Yeah. But do you think that homes could come back down to their utility value and actually be like cars where they're actually losing value over time because they're getting old as opposed to going up in value over time?
That's a really interesting idea. And, a lot of fixing the world has to do with fixing the money.
Sure.
And that's the Bitcoin revolution. I hope it works. I don't know if it will, but I hope it does. Okay. And I've certainly bet a little bit of my own wealth on it. Who knows? I mean, look, at the end of the day, everything is still driven by supply and demand. And, it might be that the equation flips at that point when it comes to real estate, Mark, and it's more based on the limited supply of land. But when it comes to the improvement, remember, people have to remember that when they buy a property, they're buying two distinct components, land and then improvement, the house sitting on the land. Okay. Those are really very different in the way they act. And that's one of the strategies I teach called the Hartman Risk Evaluator. Maybe I'll talk about that more at Market Disruptors Live. And so it might be more of a focus on land, but when it comes to the improvement value, remember that all of those individual commodity values that are the ingredients of the house, the copper wire, the petroleum products, the lumber, the concrete, the glass, the steel, etc., all of those prices have to come down as well for the price of the house to come down.
But the same could be true about a car, because a car also has those same commodities as well. Right. And cars obviously lose value. Well, not in the last year, they went up in value, but
yeah, I know. Even used cars got more expensive last year. Yeah.
Yeah. But you're absolutely right. So you have the land price and then you have the value of the home. So for example, back to my buddy's house on around the lake outside of Austin, that land had massive value.
Right.
And so maybe the price of the land's going up, but the value of the building on top of it is going down because it's a consumable item. When it's 30 years old, it's going to have to be rebuilt.
Yeah.
It's kind of like buying a private jet, right?
Sure.
At a certain amount of hours, you have to rebuild everything. So theoretically, in a sound money world, you think it could suck a lot of the premium out, and we might see real estate and other assets and stocks kind of go back to their utility value? And
yeah, I think first we have to live in a world where it isn't a credit-based world too, because real estate, like so many other things, and including stocks, I mean, stocks are hugely propped up by credit because, all those companies are borrowing money to feed their machines and, issuing bonds and so on and so forth. But with real estate, it's about mortgages. So if credit were to really dissipate, and if money were fixed, where the money wasn't being inflated, people weren't being forced to become non-interested investors, right? Like you're saying, and they have to go further out on the risk curve to protect their wealth because of inflation, because of this unsound money system we have. It's possible. That's an interesting thought experiment. I'll have to think about that one a little more.
Yeah. Yeah. And of course, gold was money for 5,000 years.
Yeah.
And of course there was loans, right? It was always the rich and the noble people that lend money to the kings, right? To the government. So there's always
go back to biblical times and Jesus and the money changers.
There was even credit then. Yeah. Well, we covered a lot of ground, Jason. I really appreciate you providing nuance. And that's the one thing I would just recommend to everybody listening is that the real estate market, well, like every subject, there's a lot of nuance. And I see today we're in this headline world where everybody reads the headline and think they understand everything, and they don't take the time to understand the nuance. So hopefully this helps. Again, come see Jason and learn about the different strategies in different markets. MarketDisruptorsLive.com. There's a link down below. And with that, check out jasonhartman.com as well. We'll put a link to that down as well. Anything else you want to bring attention to, Jason?
Yeah, Mark, I just gotta show you one thing on my screen.
Sure,
it's a quote. and I think your audience is going to like this.
Yeah.
We love to hate on the Rothschilds because they are the central banking family that started the whole conspiracy we're all being oppressed by. But the one thing you can't say about them is they were not dumb. And there's a good quote I want to share from Baron Rothschild. I thought it was kind of fitting. And there it is. It says, "Buy when there's blood in the streets, even if the blood is your own." I thought that was pretty interesting.
Yeah, I think we've heard that quote. I don't know if there's blood in the streets just yet, but
there's not. But I'm just saying, if it comes, there you go.
A video went live on my YouTube channel last night, and it's at the time of this recording, it's March 30th. And I was talking about the secret government takeover, and I talked about, of course, our good old buddy Klaus Schwab, the World Economic Forum,
Oh yeah,
and his lineage from the Rothschild family.
Oh, I did not see that one. I did not know, but why am I not surprised?
Yeah, so interesting. And he also got his degree in economics from none other than Henry Kissinger.
Oh.
And Henry Kissinger famously said, and I've used this quote from Henry Kissinger many times, he said, "Control the food, you control the people.
Yeah.
Control the energy, you control the continent. Control the money, you control the world." Now, what is the globalist main three things they're attacking today? Food, food shortages, fertilizer problems, energy, ESG, and money, pushing everything to a CBDC. And so it's no surprise that Klaus got his degree from Henry Kissinger, who outlined the three attack vectors, and that's exactly what we're seeing today. So,
Mark, you are a great student of history. I love your work, man. That's amazing. I did not know that. That's very interesting.
So, I didn't either until I started digging in. But anyway, Jason, again, thanks so much for taking the time. Always a pleasure to be with you. Appreciate the nuance you provide. Looking forward to hanging out with you very soon. And with that, we'll go ahead and sign it off.
We'll see you in Dallas. Happy investing, everybody.
All right, what a great conversation with Jason Hartman. Like I said, there is a lot of nuance into this. And I know I can already hear the keyboard warriors saying, "Oh, Mark, Jason's always this permeable. He's always wrong." Look, man, there's a lot of nuance to this. As I said in the interview, there's no such thing as good and bad timing. There's only good and bad strategies. There's money to be made in every market. And so learn to look for the nuance, and that's hopefully what you learned with some of this interview with Jason Hartman. And like I said, there is a workshop coming up. He is going to be at my event, marketdisruptorslive.com, and holding a workshop to show you how, with a one-time cash investment, you could retire in 5 years or 10 years. It's a pretty amazing plan. He's got lots of training. He's been a real estate training person for a really long time, someone I highly recommend and respect. Jason Hartman will be at the workshop, marketdisruptorslive.com. Of course, as always, give me a thumbs up on this video if you like it. If you didn't like the video, that's okay. Give me a thumbs down, but at least leave me a comment and let me know why. And that's what I got for you today. All right, to your success. I'm out.